Would you like to win and achieve success at what you do? Welcome to the Winner's Ways podcast, where we create winners every day. And now, your host, the author of Winner's Ways book and life coach, Bola Alabi.
Hi everyone, welcome to another exciting episode of the Winner's Ways podcast. I'm excited to bring this episode to you. It's almost the tax season here, and we all know that taxes is something that is common to everyone. And of course, particularly if you are like millions of Americans, you'll be expecting a tax refund in this season. The tax season starts February 15th, and you must file and complete all your taxes by April 15th. By the way, if you typically get big refunds, it means you are giving out your money to Uncle Sam, and this is at zero interest rate. This is not profitable to you, my friends. You've given the IRS free use of your money, which you could have put somewhere, maybe a mutual fund account, a stock account, or invest it in something else. We need to fix it, and to do this, you need to adjust your payroll withholding. This is something that I think every taxpayer they need to get right. So why is this important? If you maybe based on your W-4, if you are claiming too much deduction, you may owe IRS at the end of the filing period, and sometimes you can get penalized. That's on one side. On the other side, if your withholding is too low, maybe you are claiming one or two in your deduction in your W-4, then you get a refund from IRS. You need to make sure that you are paying the right amount of money to IRS. And to make a change, you need to file a new W-4 form with your employer. This will change the amount that comes out of your paycheck. So if you owe the IRS, here's what you should do. Decrease the number of personal allowance deduction on your W-4, or simply ask that a set amount be taken from each paycheck. And how can you figure out what should be taken? The way to do that is to take the amount that you owe and divide it by the number of pay period in the current year. On the other hand, if you get a big refund, you need to increase the number of your personal allowance. This adjustment will give you a little bit more cash in each paycheck. But of course, don't just spend all this money. Like I said, put it in a savings or current account, or invest it in your IRA, your Roth, or your 401k. Well, enough said about tax withholding. Today is not about tax withholding. Today is about educating you on some of the changes that you can expect in the Trump tax cut. I'm sure we all love tax cuts, don't you? I love tax cuts. I got some extra amounts in my paycheck as a result of the recent tax cuts by President Trump. So this is episode 13 of the Winner's Ways podcast, and today is about personal finance. If you can learn about the tax law and plan properly, you will not get into trouble with the taxman, and of course, ultimately, you enjoy financial peace. So on today's show, I'll be introducing the new changes that comes with the Tax Cuts and Jobs Act of 2017. The law was signed by President Trump on December 22nd, 2017. It cuts individual income tax rate. It doubles the standard deduction, and it eliminates personal exemptions. The top tax rate drops from 37%. It drops to 37% from 39.6%, while the lowest tax rate in the country remains at 10%. The law also cut the corporate tax rate for the United States. It went from 35% to 21% beginning in 2018. The one thing that you should know is that the corporate tax cuts are permanent, while the individual tax cuts will expire come 2025. As a result of the new law, the Internal Revenue Service, IRS, they've updated their tax rate and adjustment based on the law. So these are the numbers for 2019. Again, note that this starts beginning January 1, 2019. They are not the numbers that you use to file your tax return for 2018, which you will file between February and April. That means this new rate will come into effect on the tax you file in 2020. Now, for tax rate, for the low income earner, if you are a single, the tax rate stays the same. It's 10% if you earn between $0 and $9,700 for single. If you are married, if you earn between $0 and $19,400, your tax rate stays at 10%. If you are in the income bracket between 9,701 to 39,475 for single, your tax rate will drop from current 15% to 12%. If you are married, filing jointly, and you are between 19,401 to 78,950, your tax rate will drop from 15% to 12%. The next one, if you are single, and your income bracket is between 39,476 to 84,200, your tax rate will drop from 25% to 22%. If you are married filing jointly and your income rate is between 78,951 to 168,400, your tax rate will drop from 25% to 22%. If your income bracket is between 84,201 to 160,725, that's if you are single, your tax rate will drop from 28% to 24%. And if you are married filing jointly and your income bracket is between 168,401 to 321,450, your tax rate will drop from 28% to 24%. If you are in the income brackets between 160,726 to 204,100 and you are single, your tax rate will drop from the current 33% to 32%. And if you are married filing jointly, you are currently between 321,451 to 408,200, your tax rate will drop from the current 33% to 32%. And if you are in the income brackets 204,101 to 510,300, your tax rate goes from 35% to 33%. And if you are married filing jointly, and your current income bracket is between 408,201 to 612,350, your tax rate will drop from 35% to 33%. If you are single and you earn over 510,301, your tax rate will drop from the current 39.6 to 37%. And if you are married filing jointly, if you are above 612,351, your tax rate drops from 39.6% to 37%. Please go to my website www.winnersways.com. I'll put this in my show notes so that you can see the figures. But in summary, these are the changes that you must know. There are still 7 tax rates, and they are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Number 2, the standard deduction has increased to 12,200 for individual and 24,400 for married couple that file jointly. You'll be able to deduct your own mortgage now up to $750,000. And the child tax credit has increased to $2,000 from the current $1,000. The adoption credit, adopting a child basically, has changed. It's current now $14,080 for special needs child. And for all other adoption is $13,810. Student loan interest. This should interest many students. For 2019, the maximum amount that you can deduct for interest paid on student loan is $2,500. It will be phased out if you earn more than $70,000 as an individual, or $140,000 for married couples. The health savings account HSA, the contribution has changed too. For individual, it's now $3,450. It went up from $3,000. For families, it's now $6,850. It went up from $6,800. And if you are 55 years or older, you can also do some catch up and contribute extra $1,000. So how does this affect you? Among individuals, the tax plan helps. From analysis that was done by the Tax Foundation, they noticed that it helps the higher income earner families the most. They are going to benefit the most from this tax cut by receiving on average 2.2% reduction in their taxes, and those in the 20 to 80% plus income bracket, their tax reduction is about 1.7%, while the lowest earning population only see a reduction of about 0.4%. 5 notable deductions that are going away that you must know. The first is personal exemption, and this is the money you can deduct for yourself or any dependent from your taxable income. This is going away. Mortgages over $750,000 cannot you cannot claim the mortgage interest rate anymore. If you can only get interest rate deduction for mortgage less than $750,000. Moving expenses. Previously you could deduct moving expenses for job related move, but this is coming to an end as well. Tax preparation fee. Prior to 2018, fees that you used to prepare your taxes, you could deduct them, but now it's been suspended. Work-related expenses, typically when you spend money maybe on clothing, tools, union dues, you could deduct those, but with the new tax law, you cannot deduct them anymore. So those are the changes in the new tax law. I hope you've learned a thing or two. I'll keep this in my show notes because I believe you can print them out and read them. And that's the end of today's show. My quote for today is, too many people spend money they earn to buy things they don't want, to impress people they don't like. Will Rogers. Our question of the day. So when we think about taxes, people have different opinions. Some believe that the rich people should pay more. Some believe that taxes are just too high. What's your opinion about the taxes we pay in the United States? Are they too high? Are they unnecessary? Or are they just about right? Use the hashtag Uncle Sam and let's hear from you. So in closing, thank you for joining me on episode 13, where I introduce the new tax law and the changes that you should know. Obviously, I want you to win with your finances, and when we talk about tax, I want you to know the rule and play by the rule. Know all the tax deductions that you can claim and learn how you can pay just the required amount of taxes. I don't want you to pay more, or nor do I want you to pay less. I hope you have benefited a lot from today's show. Please subscribe to my podcast, rate and leave me a review so that we can attract other people to this show. Till next time, this is Bola Halabi. Now go win.